It's been a tough period for gold because despite the fact that interest rate expectations in the near term for the Fed and other central banks have not become more hawkish, in fact, arguably it's gone the other way, and the Fed is not expected to raise interest rates again, gold prices have trended lower. Let's take a look at those probabilities. The Fed is largely not expected to hike again. There is a small odds of a potential hike at one of the next couple of meetings, but at that point it does fade out and we start to look more at interest rate cuts. But you can quite clearly see that the markets are heavily favoring no more rate hikes, the end of the tightening cycle, just awaiting a little bit more confirmation from the data. But what has changed over the course of the last month or two has been expectations beyond then. You'll remember earlier this year, probably only a few months ago at this point, that the markets were expecting 3 or 4 rate cuts this year at the end of the tightening cycle. That was then pushed back into the early stages of next year. And since then, especially maybe over the last month or so, we have seen that push back maybe towards the middle of next year. So while the near-term risks to interest rates haven't really changed, the medium-term risks to interest rates have become that little bit more hawkish, which is what's weighed on gold and lifted the dollar and also US yields. So that's what we've seen over the course of the last month or so. But what did we see yesterday? Well, yesterday we saw inflation data for the US. And as you can see here, we saw a beat on both the headline and the core level. 2 very good readings. Now, headline inflation actually did rise from 3 to 3.2%, but it was expected to rise a little further. Less favorable base effects playing a key role in this, but core inflation fell from 4.8 to 4.7. So that was an unexpected decline and very much a big and important move in the right direction. The Fed is obsessed with core inflation and therefore seeing this trending lower, even if it is going to take that a little bit longer, is going to be a very welcome sign. It is also worth noting that the CPI number is not the Fed's preferred measure of inflation, but it is the first to be released by a couple of weeks. So the markets do tend to pay a lot of attention to it. In terms of what impact that had on gold, I'd say very little overall. You can see here that initially we actually saw gold spike on the back of this. So that's the red candle yesterday where you can see the long upper wick, but then it gave back most of those gains over the course of the rest of the session and actually even more and ended the day in negative territory. In terms of why that happened, well, the initial reaction was positive for gold because it was a weaker inflation number, and that is beneficial for the yellow metal. But really, I think the belief in the markets, and you can see this really across the markets, the reaction, we saw an initial spike before these moves were mostly reversed, is that while the decline was better than forecast, it wasn't entirely surprising as we've seen previously, and it's not an entire game changer either. So it didn't have an enormous impact, for example, on interest rate expectations overall, and I think that's why we've seen a bit of relief, but it hasn't really changed the trend to any great extent. But what this means from a technical perspective is that the same levels are still in play, the same levels are still important. I'm looking at that 1900 level, which is where gold ran into support in late June and early July, and that still continues to look really important for me. I think a break of that, especially after the rotation off the 50 fib around 1980 in mid-July, suggests that we are still in a negative pattern, and that this is an instrument that continues to look potentially bearish. Now, a break in 1900 wouldn't just break that prior support, it would also take us into interesting support territory from the 200-233 day simple moving average band. It would mean a break of the 200-day simple moving average band, 200-day simple moving average in itself, but it would take us into that band, which could potentially be a really interesting support zone and one to certainly keep an eye on. A break below that band would suggest that this has become significantly more bearish, effectively acting as a confirmation indicator of that break of the late June and early July lows, and suggest that we are in a longer term corrective pattern from that much longer term rally that we saw in gold towards the back end of last year, going into this, going from around November time, where we rose from around 1600, 1650 above $2,000 to hit those record highs. It would suggest that we are seeing a broader correction of that move rather than a continued run at 2000. Now, what I would say is that there's a lot more economic data to come over the course of the next couple of months, and I think based on what we've seen more recently, we are seeing much more favorable data on the inflation front. We're seeing a lot more favorable data on the surveys and on the employment data as well. but also we're seeing signs of resilience in the economy. So people are becoming increasingly confident that a recession can be avoided, and we can see the end of tightening and even see interest rate cuts towards the middle of next year. Now, those expectations have changed considerably over the last couple of years because we are in relative uncharted territory, but there is more optimism growing. And if we can see more signs of inflation abating over the course of the next couple of months, that could continue to be beneficial for gold over the medium term, even if the near term trend is looking less positive.